Nearly 40 of the world's largest financial institutions, including JPMorgan, Goldman Sachs, BlackRock, Vanguard, and the New York Stock Exchange, are participating in a live trial to tokenize U.S. stocks and Treasury securities using blockchain technology. The initiative is being led by the Depository Trust and Clearing Corporation, or DTCC, the organization responsible for safeguarding more than $114 trillion in securities and processing quadrillions of dollars in transactions every year. This isn't another crypto startup experimenting with blockchain. This is the core infrastructure of the US financial system, beginning to integrate blockchain technology into traditional financial markets. So, what exactly does this mean? Why are some of the biggest names on Wall Street suddenly embracing tokenization? And how could this reshape investing over the next decade? Let's break it down. First, let's understand what's actually happening. The DTCC is conducting a production trial where traditional financial assets, including US stocks, ETFs, and Treasury securities, are represented as blockchain-based digital tokens. Some of the assets included in today's trial are Microsoft shares, Circle Internet Group shares, the Invesco QQQ ETF, the SPDRS and P500 ETF, BlackRock's iShares 0 to 3 month Treasury ETF, and various US Treasury securities. These digital versions are known as tokenized assets. Now here's an important distinction. These are not synthetic tokens or wrapped versions that simply mirror a stock's price. The goal is for these blockchain-based tokens to represent the actual underlying securities while preserving the same legal ownership rights, dividend rights, and investor protections that investors receive through traditional financial markets. That difference is enormous. So what exactly is tokenization? Think about buying a stock today. When you purchase a single share of Microsoft through your brokerage account, the process involves far more than just pressing the buy button. Your broker communicates with clearing firms. Those clearing firms work with custodians. Settlement systems update ownership records. Banks transfer funds. Multiple databases across the financial system have to reconcile those transactions before ownership is officially transferred. Many of these systems were built decades ago. Blockchain introduces a completely different approach. Instead of ownership existing across numerous independent databases that constantly need to communicate with one another, ownership can exist as a secure digital token recorded on a shared ledger. A simple way to think about it is this. Imagine 10 different companies all emailing updated spreadsheets back and forth every day. Now replace all of those spreadsheets with a single shared Google document where everyone sees the exact same information in real time. That's essentially what blockchain can accomplish for financial markets. It dramatically reduces complexity while increasing transparency and efficiency. So why is Wall Street interested? The answer is simple: efficiency. The first major benefit is faster settlement. Today, US stock trades generally settle on what's known as a T+1 settlement cycle, meaning ownership officially transfers one business day after a trade is executed. Blockchain has the potential to reduce settlement from an entire business day to nearly real time. That may not sound exciting, but for financial institutions moving billions of dollars every day, reducing settlement time lowers counterparty risk and frees up enormous amounts of capital that would otherwise remain tied up during the settlement process. The second benefit is better liquidity. Large financial institutions constantly move collateral between banks for lending, derivatives, repo markets, and countless other financial transactions. If those assets exist as programmable digital tokens, they can potentially move much more efficiently. That means collateral becomes easier to transfer, capital gets utilized more effectively, and liquidity throughout the financial system improves. This is one of the reasons Wall Street has become so interested in tokenization. The third advantage is lower operational costs. Today's financial markets rely on numerous intermediaries, and every intermediary introduces additional operational expenses. Blockchain automates much of the reconciliation process because every participant is viewing the same shared ledger. Over time, that could significantly reduce costs across the financial industry. While those savings won't happen overnight, the long-term efficiency gains could be substantial. Then there's what many people consider the most exciting feature of blockchain: programmable finance. Traditional assets are largely static, but blockchain-based assets can become programmable. Imagine collateral automatically moving when certain conditions are met, dividend payments being distributed instantly, corporate actions are processed automatically, entire financial workflows are becoming software rather than paperwork. That's where tokenization becomes much more powerful than simply putting stocks on a blockchain. Now you might be thinking, haven't tokenized stocks already existed? Technically, yes. Several companies have launched tokenized stock products over the past few years, but most of those products were essentially wrapped assets. They tracked the value of a stock but didn't necessarily provide the same legal ownership rights as holding the actual security. This DTCC initiative is fundamentally different. The objective is to tokenize the actual securities while preserving investor protections, voting rights where applicable, dividend rights, and existing regulatory oversight. That's why this announcement carries far more weight than previous tokenization experiments. So why should crypto investors care? Because tokenization is rapidly becoming one of the largest long-term opportunities within digital assets. If trillions of dollars worth of stocks, bonds, treasury securities, money market funds, and eventually real estate move on-chain, someone has to provide the infrastructure. Someone has to operate the blockchain networks. Someone has to provide a digital identity. Someone has to secure custody. Someone has to deliver smart contracts. Someone has to provide reliable data through decentralized oracles. Someone has to enable interoperability between multiple blockchain networks, and someone has to provide stablecoins that facilitate settlement. This is exactly why so many investors believe tokenization could become one of the biggest growth themes for blockchain technology over the next decade. Of course, there are still challenges. The biggest one is regulation. Financial markets are among the most heavily regulated industries in the world. Every blockchain-based settlement system must comply with securities laws, investor protections, custody regulations, anti-money laundering rules, and countless other regulatory requirements. The good news is that these trials are taking place within a regulated framework rather than outside of it, which gives institutions confidence to begin testing the technology. Another challenge is technology integration. Wall Street cannot simply replace decades of financial infrastructure overnight. Existing systems already process enormous trading volumes every single day. Instead, blockchain will likely be introduced gradually alongside existing infrastructure. This transition could take years, and that's completely expected. Large financial markets simply cannot flip a switch overnight. Privacy is another important consideration. Unlike public cryptocurrencies, where transactions are visible on open blockchains, financial institutions require confidentiality. Large banks don't want every transaction publicly visible. That's why many institutional tokenization projects rely on permissioned blockchain networks that provide the benefits of distributed ledger technology while maintaining privacy, security, and regulatory compliance. So what happens next? Today's production trial is just the beginning. If successful, DTCC plans to launch a production tokenization platform that participating financial institutions can begin using for eligible securities held within the existing DTCC ecosystem. That doesn't mean every stock suddenly moves to blockchain tomorrow. Instead, expect gradual adoption, with more financial institutions joining, additional asset classes becoming tokenized, greater interoperability between blockchain networks, and deeper integration between traditional finance and blockchain technology over the coming years. The biggest takeaway from today's announcement is this. This isn't about cryptocurrency replacing Wall Street. It's about Wall Street adopting blockchain. That's an incredibly important distinction. The world's largest financial institutions are no longer debating whether blockchain technology has value. They're actively building with it. When organizations like JPMorgan, Goldman Sachs, BlackRock, Vanguard, the New York Stock Exchange, and the DTCC begin developing real-world blockchain infrastructure for traditional securities, it sends a powerful message. Blockchain is evolving beyond speculation and becoming part of the financial infrastructure itself. While this transformation won't happen overnight, today's announcement could represent one of the earliest steps toward a financial system where traditional assets move faster, settle more efficiently, operate at lower cost, and become increasingly programmable. Whether you're an investor interested in blockchain technology or simply curious about where global finance is heading, this is definitely a development worth watching. If you enjoyed this breakdown and want more educational content covering blockchain, tokenization, investing, personal finance, and the future of financial markets, make sure to subscribe. Thanks for watching, and I'll see you in the next video.